Welcome to the show today. We're going to talk about your money. We're going to talk about how to keep more of your money and make more on the money you keep. We're going to talk about little known secrets that if you have a financial advisor, they're not telling you about. And if you don't have a financial advisor and you go to get one, they're not going to tell you about either. So with us today is Michael Brown. He's a co-founder and managing member at Red Fox Capital and brings over 20 years of experience challenging the typical financial advisor to think beyond conventional investment advice. And his clients experience innovative approaches to building generational wealth and tax strategies through his innovative integrated asset management investment philosophy. Now, Mike is the author of the best-selling book, The Real Perspective Investment Secrets Your Financial Advisor Won't Tell You About, that shares his step-by-step strategy that his clients have used to build retirement income and wealth while both lowering their taxes at exactly the same time. Now, Mike was named the youngest director of finance by the National Republican Senatorial Committee to lead the finances of a U.S. Senate campaign. And Mike was also named the national director of finance for Team 100, an elite organization created by President George H.W. Bush, which comprises of the country's top business leaders and wealthy families. Mike, thanks for coming on with us today.
Thanks, Ty. Glad to be here.
Well, I'm really excited that you could be here. So a lot of stuff I want to dive into, because I think your book is what the stuff you guys the stuff you cover there is outstanding. So let's start from the beginning. I mean, what's wrong with trying to pick your own stocks?
Well, it's in my regard, as far as Wall Street picking stocks is you might as well have a monkey do it. Throw darts at the dartboard. They move in trends with the larger picture, and that's why one of our strategies is to look at diversification. One of the problems we see out there with the traditional financial advisor is he tells his clients, "You're well diversified. Don't worry, we've got you in all these different stocks and mutual funds, ETFs, etc." But what they don't realize is you're well diversified only in Wall Street products. So what we try to do is integrate other private investments, alternative investments into someone's overall portfolio, which reduces the risk profile, but also raises the returns.
So you have, and we talked about this in your bio a little bit, integrated asset management. What is that?
Well, what we do is, just like I said, we take your traditional Wall Street portfolio, which we still believe you need, exposure to the stock market and other products on the Wall Street machine. But we also look at bringing in our favorite investment is private commercial real estate. So we bring in, private funds that deal directly with the sponsors and specific assets. And that is to really balance out someone's investment portfolio into what we call a healthy asset balance.
So tell me a little bit more. I mean, how does that really help reduce risk while still increasing your clients' returns?
Well, first of all, if the stock market, we may see in this election climate, a roller coaster ride, the stock market. With real estate doesn't operate like that. It's pretty steady. We also have real asset-backed collateral. We have buildings that we have low leverage on. So there's at least some stability there. We know what kind of income is being derived off of the real estate products. We have rents, we have leases in place, so we know what that income is going to be. So for an investor who's betting on an income stream, we can say, you're going to get a dividend check in the mail for 8-9%, like clockwork. Unlike the stock market, depending on your age, where you are closer to retirement, those kind of things could be more volatile and take some time to really catch back up if there is a correction in the markets.
Makes sense. What about risk tolerance? Why is risk tolerance so important?
Well, I think risk tolerance is important because, a lot of times people don't really understand it. So we need to step back and look at a client and figure out what their true risk tolerance is, because a lot of times they may know. Let's be aggressive, but really and truly, can they afford to lose 40% of their stock portfolio? I think, there's one thing after studying a lot of successful and wealthy people, the one thing that comes as a common denominator is wealthy, successful people hate to lose money. They like to protect that principle. It's the old Warren Buffett rules of investing. Don't lose money, number one. And number two, don't forget number one, don't lose money. So risk tolerance comes into play there. Let's, grow your wealth, but let's also protect your principal.
So how do we figure out individually kind of what our own risk tolerance is?
Well, I think, suitability is something that's very important when you're looking at an individual investor, is to step back and say, okay, let's look at your situation. Let's see what your time horizon is to retirement. Do you want to retire? What is it going to take to get to that stage in your life? What is the rate of return that's going to be needed to hit those goals? And stepping back and looking at a full analysis and those criteria, we're able to then, I think, give somebody a true risk tolerance. And the amazing thing is, you really don't need a high risk tolerance to build wealth and income. I think a lot of people think they may need 8, 9, 10% of a rate of return to hit their retirement goals. But really and truly, we see a lot of people hitting those goals with as low as 3 and 4% rate of return and a much safer, lower risk profile.
What's wrong with today's, status quo financial advisors? I mean, what do you think they're doing that creates such a disservice to their clients?
Well, I think they have tunnel vision underneath wherever they may work. For example, I worked at Merrill Lynch, and at Merrill Lynch, we were forced to sell Merrill Lynch Bank of America products. We were prohibited from speaking about private commercial deals, any kind of investment opportunities outside of the umbrella of Merrill Lynch Bank of America. So that is one of the conflicts that I saw that was a harm to the clients. And one of the reasons we left and created our own financial service business called Red Fox Wealth, to integrate all those services under the same umbrella and reduce those conflicts of interest. Another problem we saw with financial advisors is they don't want to work with other outside advisors because their fees are going to leave and go to those other experts. And that, I think, is a true conflict of interest that is not the best benefit of the financial advisor. We see, we're a fiduciary, and some of the larger wirehouse financial advisor firms, they're not fiduciary. So the client's best interest is really not at the forefront.
So why do you think that continues to be the case? I mean, why is that allowed?
That's a great question. I don't know. It's money. I think that some of the big wirehouses, the brand names, if you came to me and said, I'm going to invest my money with Morgan Stanley or Merrill Lynch or UBS, you have that ill-conceived safety with the big brands that you may feel safe. And they do a good job of promoting those brands. But in reality, they are truly, they're not fiduciaries and have the best interest in the clients.
So what if somebody's just getting started? I mean, what are the first steps that somebody really takes to start getting into investing?
Well, I think, first thing is, set aside some money, get on a plan that you're going to pay yourself first. We've all heard that. Before you pay anything else, pay yourself first and take some of that money and start building your nest egg. I think then figure out a way, depending on your situation, how to grow that as quickly as possible. If your company's offering a 401k and they're doing a good matching program, obviously that's where you're first going to go to defer some of your tax liability. And then, figure out what your cup of tea may be. Is it going to be building a real estate portfolio? Do you want to play the stock market? It's really up to the individual, but the first thing is set a goal and start saving some money to do it.
What do you think is, are good investments for beginners to kind of get started with?
Well, I think depending on what category we're talking about and the Wall Street side, I think, an ETF, just a fund that's going to track the markets is probably the safest and easiest way to get in. They're low cost to get into those type of situations. On the real estate side, I think, I'm more biased toward commercial real estate. I see there's more upside, there's more ways to drive value. So, sometimes that commercial real estate has some barriers to entry because the products they're much larger and more complex. So in that regard, invest in a fund. invest with a good sponsor that has a solid fund that can get you a good return, and you don't have to worry about the day-to-day landlord issues. So I think that's probably the best place to get started.
You mentioned commercial real estate and
Yeah.
stocks and bonds. Outside of that, what are some other classes that people can kind of get invested into?
Sure. Well, there's all kinds of things in the alternative class. You see the precious metal markets that are heavily advertised, or you see a lot of people moving their self-directed IRAs into gold and silver and such. That's one possibility. I think outside of that, in the alternative space, you're going to see a lot higher risk profile. Investing in businesses, private equity. You're not going to necessarily see returns quickly. It's like the old private equity hockey stick. You're going to have zero return, and then if you're lucky, you're going to see a high at the end. But I think for beginners, I would steer them away from alternatives. They also may be prohibited by their net worth, being what we call accredited investors, where you would need $1 million net worth to participate in those classes.
What are other things? I mean, before people even consider, getting into investing or, continuing to invest in more things, what are some things that they absolutely need to consider?
I think first of all, having a nest egg for emergencies. We've always learned, the standard is 6 months in the bank, just cash liquidity able to get to if there's anything that may happen. Sometimes I even say we should go 12 months because in today's world, the job market, the COVID issues, you may need a little bit more reserve there. So first thing I would do is cash away, cash to carry you through 6 to 12 months. And then at that point, we'll start dabbling with maybe some ETFs, funds, and then go into the real estate side.
So before somebody kind of talks to you, if they've tucked away money, how much money should they really have to invest before they kind of talk to you to figure out what's the best strategy to start investing?
I think you can invest with as little as $100 in today's world. They've created with the discount brokerage and some of the more democratized the stock market. So individual investors can really start getting in at a very low amount. You see some of the services out there now. You can buy fractional stock in companies if you can't afford. Amazon and Apple are trading at such high numbers. So to go in and buy a large lot of stock, it costs a lot of money. So you can look at some fractional situations where if I only have $300 to invest or $100 to invest, you can buy fractions of different stocks for a low amount of money, which is good for people.
What about failing markets? I mean, COVID, obviously things have rebounded pretty quickly, right? But, we look at the mortgage crisis and things where it didn't rebound as quickly. So what do you see smart investors do, or what do you advise smart investors to do in a market that's maybe not failing, but not doing really well?
Well, I think, hold the course. I think, emotion always comes into play. That can be detrimental. There's the whole, behavioral finance world, is a study now of people making bad decisions during bad things. So, actively trying to trade and look at panics to sell out too early, you may miss a lot of opportunities. Some of the best, portfolio managers in the world still have struggle actively trading accounts, trying to find and time the markets. It's a very tough thing to do. So I would say hold the course during any kind of times of crisis and don't overreact.
What about market fluctuations? What do you advise your clients to best deal with those?
I think, hold the course. I think, or turn it over to some of our portfolio managers that we have that are able to tactically trade on a daily basis and play those markets and try to take advantage and do some stop losses so we can limit the downside and then take the gains. So those are things that we encourage people to look at. Depending on your age, as you get older and to probably over the 50s, we even start to look at allocating some money into more annuities and insurance products that are completely protected and guaranteed without any fluctuation to the Wall Street markets.
What are some of your best kept, secret investment strategies to kind of mitigate this uncertain time, because we've got two things going on, right? We've got
Yep.
COVID and we've got an election right now as we talk that, we
Right.
don't know what's going to happen and how things will change after this. So what's your kind of some of your secret investment strategies to kind of get through this turbulent and uncertain time?
Yeah, I think private commercial real estate is a great place to be. Commercial real estate, they're not making any more of it. The old saying, land is, it's a finite asset. We see things in the industrial space that are really solid right now, especially with the e-commerce boom, where Amazon is taking over the world and they have to have warehouses and distribution centers. That's an area we really like. We really like some of the recession-proof retail spots like Dollar Generals, some of the home improvement areas for stock, but also for the real estate. So we're right now have a fund that we're purchasing individual Dollar Generals into a large portfolio, which we believe are recession-proof. We're able to offer dividends of 8 to 9% and with some upside. So I think those are some secrets that a lot of individual investors don't have access to, or they don't know how to get access to those kind of products. So that's one thing we're trying to bring to the market for people.
So I think commercial real estate's interesting, and let's spend some time there because,
Yeah.
like, from what I've seen in the mortgage crisis, residential falls and commercials about a year after. And I mean, I don't know, I'm
Right.
just, saying that, but so it seems like that, we're about ready to see a really significant dip potentially in commercial real estate over the next 2 years. Is that kind of what you think? And is that why you think the timing is good to really consider getting in right now?
Well, I think you're correct. I mean, typically commercial real estate lags about a year to 18 months. But what we like about commercial real estate versus the residential side, typically you have a lease in place with a tenant for about a year. Normally, it's never going to go over there. There's a lot of turnover and uncertainty. In commercial real estate, we have longer term leases that are in place. So we would have typically anything 5 to 10 years with extensions. So we know that that cash stream is in place. And we also have built-in escalators into the rents. So we know every year we may get a 3 to 4% increase in income. That's in a lease, guaranteed, and sometimes even corporate backed. So if there was a store, individual, location that may be in trouble, we have the corporate guarantee behind it. So I call it a corporate bond with real estate in those situations. There's I think, lower volatility in the commercial space more so than the residential space, a little more stable.
Makes sense.
So,
And why do you think that commercial real estate overall is such a really good investment right now?
well, I think the two words that I think make it the most special is called forced appreciation. If we can, let's compare the two. A residential property, we have tenants. It's very difficult to raise rents or make improvements to the value of those properties. The market's really determining our valuation. In a commercial property, if I tweak the rent a bit, if I can lower expenses, if I can do something to improve the net operating income, it'll build the cap rate to that property and really drive the valuation that is extraordinary when you compare the two. And that's really the secret sauce between residential and commercial.
Makes sense.
Yeah,
What about Wall Street products? Do you think today's investors are kind of overexposed to what's going on Wall Street?
I think some are. I think some are, and some are not. I think we try to limit our clients to about a 50% exposure to Wall Street at the most. As they get closer to retirement age, we try to lower that exposure to Wall Street into more safer products with guaranteed income producing products. So I would say they are definitely probably overexposed to Wall Street.
Why do you think, and some people have the strategy or philosophy that you shouldn't be investing in Wall Street at all. So
Yeah.
why do you think that it's a good idea to still be investing in Wall Street, but just in a limited capacity?
I think diversification. I think, like we said, I mean, now I do have clients that are all in real estate or they're all into Wall Street. I mean, real estate guys I seem to find are more intense about their argument that I want to be in real estate. I can see it, I can touch it. It's there. I have control over it. But trying to bring those guys back into more diversification is more difficult than taking guys on the Wall Street side and trying to diversify their asset allocation. So it's a balancing act.
What about building a portfolio? If you are building a portfolio and you are investing in to Wall Street products, how do you effectively build a well-diversified portfolio?
Well, the easiest way is just to do a fund that's tracking the overall market. But I would step back and look at the individual situation. You may have a particular client that's really looking for a dividend play. Maybe they're just looking to create income. So if whatever the valuation of the stock may be, they're still going to have a guaranteed dividend, kind of like what we talked about with the real estate side. So if we have a particular client looking for growth, if they're young enough to absorb a market correction, then we will put them into more an aggressive portfolio. But I think, picking individual stocks is a difficult thing. I would recommend anyone probably to go into a professionally managed uh, portfolio, have a professional manager, doing that day to day for you. And that's probably your best bet to create wealth.
How do you know that you're working with the right advisor in that space?
Well, I think that's a tough thing. I think you need to, first of all, pick a fiduciary financial advisor where your interests come first and he's bound by law for that. Um, and then number two, do your due diligence. I mean, look at exactly what they're doing and why they're recommending that. Is there some kind of, are they bound or captive to certain portfolio managers? We go out to a whole bunch of portfolio managers that if they don't perform, then they're eliminated. Some firms, they can't do that. They are stuck and married to portfolio managers that, just maybe be mediocre and they can't do anything with it. So I would look, it's like the old independent insurance agency or a broker, a mortgage broker. Get somewhere where you can have a financial advisor that can shop and be competitive and look at a large array of different solutions for you and then pick the best.
When you have somebody like you that you really trust to manage a portfolio, then how often should you be checking in on really what's going on?
Yeah. Well, sometimes overlooking it can be scary. They always say, I don't want to open my envelope to my 401k. I think, we do an annual review once a year, at the most, our big review to look and make sure we're hitting our goals. But I like looking at something every quarter, to make sure that we're on track. Sometimes clients have life events throughout the year, most likely. So let's readjust at that point. So I think a safe thing to do is to sit down with your advisor on a quarterly basis, but at a minimum to do an annual review to really look at it and make sure we're on track and everything's allocated properly.
What are some other secret investments or secret investment strategies that typical financial advisors don't tell their clients about?
Well, I think the real estate for one, just because they don't have access to it. I think the problem is with their typical financial advisor, like we said earlier, they have a plate of portfolios of individual mutual funds and such, that's all they're allowed to provide their clients, and that's the one thing that I find to be the biggest hurdle. Find an independent firm that's able to really shop and give you the best products available.
So what are some, and you're spot on. I mean, I don't think I've heard a financial guy on the podcast ever mention, really dive into commercial real estate and the value there. What are some things that you should really look for when either choosing an advisor or really trying to evaluate yours to see if you've got the right one?
Well, I think first of all, hopefully you'll go into a meeting when you're interviewing a new financial advisor about, what your goals are and see what their opinions are to it. You may even just have a personality conflict. But the biggest problem that we see with clients moving away from some of the larger firms it's just lack of communication. Financial advisors, once they get your money under management, they forget who you are. You become a number. And with some of the larger firms, when you have 2, 3, 4, 500 clients, depending on your asset value number, if you don't have a lot of money, then they're not going to spend time with you. They just don't have enough time in the day. So make sure, depending on your portfolio size, that you can match with an advisor that's going to communicate with you, that you can speak to, returns your calls, and you believe in their investment philosophy.
Makes sense. As
Yeah.
we get ready to wrap up, any, parting advice, some things that maybe we didn't cover that we should have for anybody that's interested in getting into investing or already investing, but, to make sure that they're investing with the right person or considering a change?
Well, I think, step back, educate yourself, think outside the box, take a look at my book. It's if anybody wants a free copy, they can, for your listeners, send me an email. I'll send them a free digital copy right away. And it talks about how we take the financial service industry and disrupt it. How we're going to incorporate all those different things we talked about today on the show, and give you a history of Wall Street and how we incorporate real estate into portfolios. So be happy to do that for your listeners. And take a look at your current portfolio. Let's make sure that it's balanced correctly. And, if it's not, ask your advisor, challenge them. Why am I overly, exposed to these certain areas in the market? Why can't I do this? Ask questions, challenge your advisor, and keep an open mind.
What's your email to get a free copy of the book?
Yeah, sure. I have a private email just for your guys. It's Mike Brown 1757@gmail.com. And then our website is redfoxcapital.co. We have some downloaded material there on private real estate. And then our wealth management site is redfoxwealth.com. So anybody that wants to come in, let me know that they're your listener, and we will take care of them.
Thanks for coming on the show today.
All right, Ty. Thank you so much.
So everybody, 20, 25 minutes here, we've learned a ton of stuff that I don't think that you've probably heard from interviews with 10, 15 different financial guys. And that's because, again, Mike teaches the investment strategies that most financial guys aren't going to tell you about. And we just dipped into one of those today with commercial real estate, but there's a ton of great stuff on the website, on both the websites. So make sure you check out both redfoxwealth.com and also redfoxcapital.co. So that's redfoxwealth.com and redfoxcapital.co. And if you want a free copy of his book, you can get it on Amazon, and I'll include the link as well to go to Amazon and buy it. But if you want a free copy, then you can email Mike Brown 1757@gmail.com. That's Mike Brown at 1757@gmail.com. So email him for a free copy of the book. Visit the website because there's a ton of additional information that we didn't even get into today, and put yourself on the right track to be able to get the strategies that your financial guys aren't going to tell you about, so you can build more wealth even faster. Thanks for tuning in. Have a great day.